work at every month in a stock market.
So stocks that find themselves being relevant to multiple themes
means
can make it in.
Yeah, so it'll have like one thing pulling it if something's not pushing. That's right. If you pulled up the MTUM, which I don't have here, it doesn't look like the same list.
Okay.
It did see a drawdown February to April. So a bear market caused this to underperform, but then the recovery or stabilization causes to make up all the ground lost.
Many investors are apprehensive about the stock market's increase. The S&P 500 has produced robust, double-digit returns in spite of a number of possible calamities, including fierce global conflicts and the most aggressive Federal Reserve interest rate hikes in contemporary history. Many people find this resilience strange, and detractors have dubbed the development a limited, AI-driven bubble that will eventually burst. They see a market that is dependent on a single subject and susceptible to any change in attitude. Tom Lee contends that this widespread mistrust is not a red flag, though it is the most obvious indication that the bull market is still in its early stages, with cryptocurrencies set to emerge as the next significant force behind this growth. Lee carefully breaks down the bear case, pointing to a market that has survived several economic shocks and come out stronger as corporate profits have continued to rise. He positions cryptocurrencies as the next frontier for institutional adoption, while arguing that the typical stock is not overvalued when examined through an equal weight perspective. His belief that a new financial cycle is developing is based on a combination of conventional market resiliency, fair equities valuations, pervasive investor skepticism, and the burgeoning crypto revolution. The next leg of this bull run will be fueled by digital assets due to the generational gap in cryptocurrency adoption and Wall Street's increasing blockchain integration. To learn more, let's now view snippets from Tom Lee's bombshell interview. For more in-depth content, please remember to like, subscribe, and turn on notifications. Thank you for coming back. Watch the remainder of the video.
That's sent, and people respond if things are better, worse, or the same. So it doesn't have any political bias. It doesn't have any like. But if they're answering it in a negative sense, that means that they're cautious. Like, you remember when you are this far forlorn and dejected, and then you flip positive, you won't just go to 50 and then it's over. We're probably going to have 4 years of this staying above 50. I mean, if you look at the history, once it breaks above 50, it's multiple years. But this could be a record stretch above 50. It's still more correlated with S&P earnings than the services index. Members of the Institute of Supply Management. So it's basically the survey.
It's like factory foreman,
but it also could be the Intel, NVIDIA purchasing manager. Although they get one vote, right? They get one survey.
Okay, so tech is in here.
Everything
else.
Okay, or it doesn't get more unstable.
Okay.
You get a Fed that's dovish.
Okay.
But then you need this third thing to happen. You need the excess spread on interest products to fall. Like today, if you're borrowing for a mortgage, it's normally only been at 160 basis points above the 10-year, or like 1.6%. So the 10-year's at 4.2. The 30-year mortgage should be 5.8.
But it's not.
But it's like 7. So there's excess spread on mortgages. But as soon as those other two things happen, I bet you that spread drops. It's actually hard to explain. Someone says that it's either banks worried about prepayment velocity, so because they're going to charge, so they charge an excess spread, or it's uncertainty about the value of the collateral. Like, can home prices drop so you have to charge a high rate because they're only putting 20% down?
Wait, the spread is high because they know that if and when rates drop, people are just going to prepay.
Yeah, so you lose money. Yeah, you're losing money.
Or refinance.
But if they're answering it in a negative sense, that means that they're cautious. Market doesn't have as much hedging, and there's a QT, and so like it's harder to get spreads moved out. But for whatever reason, it's unusually wide. It's like 50 or 60-year wides. Say there's 20 trillion of mortgage debt out there, and like half is above that rate. That's 10 trillion times 1.6 percentage points. Like, that's money in people's pockets. Plus, how many more people are going to get mortgages now that it's 5%? So think about how much money that drives housing recovery and liquidity, and people starting to upgrade their homes. Remember, like Home Depot said, the upgrade projects keep getting pushed out.
Yeah,
it's like a rethinking of shelter, because people will want to own housing, but they're too expensive. Like, maybe there'll be new kinds of smaller homes being built or demand for modular, but people will borrow money to get a home.
Okay. All right. I like that idea.
Lee's perspective is based on facts that defies consensus. The S&P 500's equal weight price-to-earnings ratio, which is currently 25.9 times, is a significant component. Even after the surge, equities are not much overpriced overall, as seen by the fact that that number is only marginally higher than the 6.3 times average. This follows the market surviving 6 distinct killshots, which are shocks that typically cause crashes. These included one of the fastest Federal Reserve tightening cycles in history, the largest inflation spike in modern history, global supply chain disruptions, and geopolitical shocks like the U.S. attack of Iranian nuclear sites. The market held steady and profits increased rather than collapsing. This resilience is viewed as a significant strength rather than a flaw. Another factor is the ISM Manufacturing Index, which has been in contraction for a record 28 months. This is seen as a spring waiting to be released rather than as deterioration. An increase in company confidence may lead to a surge in investment and spending. It also casts doubt on the assertion that a small number of megatech companies are driving the rally, given that industries like utilities, finance, and industry are all rising because to the massive surge in AI spending throughout the economy. Now, let's return to the interview.
Money on it for now on the current income.
Okay.
And then third is, of course, like the mortgage market.
Finance.
Yeah, so the velocity hurts
Are
you.
you worried about the labor market at all?
Yeah, I mean, because we know we're not tracking it correctly anymore because ADP probably tracks it correctly, but they don't seasonally adjust correctly. And then we know the BLS numbers are different. But overall, I think the labor market is softer. I also think there's a lot less hoarding. That's why there's no pricing power anymore, right? Companies were holding on to employees, now they're just letting them go. I think it is a big problem. I mean, I think it's observable. It's like too many things that could explain it. Because one, the
AI.
AI
Right.
means there's a huge mismatch because most people aren't equipped to do the jobs that are going to be in the future available for AI. Second, I think there was this oversampling of people pursuing like liberal arts degrees expecting a job. I mean, liberal arts education's good, but we probably we have now a huge shortage in trade workers, like massive shortage. Like it's to such a degree that AI robots are doing jobs that normally were trade jobs because there's a shortage.
Yeah.
So it's really complicated. But I guess I advise my kids, because I have 3 kids, like age 20 all the way to 28, that, there's no linear careers anymore, right? It's a very different future. You might be paid for something that you didn't go to college for. Like you may just be super creative and that's your most virtuous skill, but that wasn't what you went to college for. Well, I think a lot of people who work in the financial services industry are actually good, have personal experience of what is happening to the rest of the country, which is Wall Street got disrupted by AI a long time ago. Like that's why trading went electronic.
It's all
That's
computers.
Yeah. And research shrank what you need because you can just use. So everybody who's worked on Wall Street in the last 20 years has already seen their lives disrupted. And
Yeah.
plenty of people survive, but you had to have been adapting to it. Some people will make money passively.
Okay.
You know what I mean? Like some people may make money because they bought stocks. I mean, maybe people should just buy stocks early because, but as you know, like when you look at people who bought basketball teams and like the compounded return, you actually did better just if they had put the same amount of money in the S&P. I mean, they didn't get to go to like get courtside. It's like, remember people used to say like, oh, buy a house when you're 20. Now maybe we should just say buy the stock market because now you're long the AI disruption through equities.
Invest in your
researcher.
Yeah.
And so you
like the BLS.
I like the BLS. And it's like me getting fired, and it happens to me all the time, by a client because the market didn't do something they wanted, but I get blamed for it,
Yeah.
So I empathize with the BLS. I think that they're probably really well-meaning people, want to get the right number, but they have incomplete information. But perhaps they should be making very clear the standard error, because the known standard error is like hundreds of thousands, and they never post it. But it's in every chart, like those little circles on the line, so you know what the high-low of a one sigma error is. There's probably better ways to track the job market, anyways. Like
I agree.
Cell phone tracking.
So why?
Because you could see who's going to the
moving?
office, or you could see how many people are at Starbucks when they should be at the office. I mean, like accurate. It's like, it's not 100% of the population, but it's very accurate. If the Fed realizes real interest rates are too high because tariff inflation is transitory, and so they should look at break evens and realize 4.5% Fed funds versus 2.5 is 200 basis points extremely tight. If you don't even think you're going to hurt the job market, it's clearly hurting the job market. I think that a dovish cycle is going to get the ISM back up. So I think it actually is expansionary.
Okay.
S&P was up 2% after his speech.
Yeah.
I think we're gonna rally tomorrow,
Okay.
even if he's hawkish and exerts his independence.
Why? Just
Really?
because it'll be over and people are waiting for it to be over?
Yeah, because we would expect him to exert his independence, but it doesn't have negative implications because he's already on hold.
I don't think he's going to do like a highly politically charged thing.
Nah.
Wow. See, then the market's going to go up even more.
Yeah.
So it's, yeah. And he's from what I've heard, because I don't know him personally, high integrity person,
Yeah.
a really class act. So you're right. It's more consistent with what you're saying. That's right. And also knowing in September, there's a big revision the annual revision, which is probably going to make all those previous job reports look even worse. I'm just a fan of an independent Fed. I'd, let the Fed do their job. We know crypto is a generational divide because if you did the survey with someone under age 30, it's probably like 50% own crypto. But history shows pretty clearly it's people in their 20s and 30s that are driving all future change. Credit card spending shows it is. So imagine like if your neighbor one day discovered oil in his backyard and became like really rich.
Oh, you would hate his
You'd
guts.
hate him for
I agree with
That's
that.
it.
and
That's
then
it.
he's like becomes an oil evangelist. You'd be like, I hate oil.
Enough with the oil.
By the way, there was a rebalance last week, so there's some removals.
Okay.
But yes,
Okay.
because we did our quarterly rebalance last week. But yes, those are the names. They one of the themes that is in here is millennials, and so not everything is an AI story. Because like Monster is an example of a millennial.
They
stock.
love it. Yeah.
Correct.
That's their Coca-Cola.
Yeah, and the idea is there's plenty of millennial stocks, but we wanted to have a stock that's tied to two themes. So Monster has to be tied to another theme. As you can see, it's tied to millennials and then style tilt. Seasonality. So the reason that matters is that a single theme won't always. Yeah, so it'll have like one thing pulling it if something's not pushing. That's right. If you pulled up the MTUM, which I don't have here, it doesn't look like the same list.
Okay.
It did see a drawdown February to April. So a bear market caused this to underperform, but then the recovery or stabilization caused us to make up all the ground lost.
Okay.
So I would say this is trying to find the 30 most important stocks in the S&P that are tied to the growth drivers.
Okay.
So it's kind of a bit more growth oriented.
Can I pick
with that? And we do record a video every week with our granting shot, so people have full transparency of like what's working, what's not. And I think that
all of the signals combine to form a single, distinct image for Tom Lee. This bubble is not a late cycle bubble that is about to pop. This marks the beginning of a long-term bull market. He views the fear and incredulity that many perceive as warning signs as the real forces behind what he refers to as the most despised rally in decades. He contends that this wall of doubt is not a weakness, but rather the very factor giving the market more ability to rise, since skepticism creates momentum when solid evidence points to growth. His assurance extends to cryptocurrency, which he describes as one of the most promising sectors of the upcoming 10 years due to its obvious generational adoption gap. According to surveys, younger investors under 30 are rapidly and firmly entering the cryptocurrency market, while roughly 3/4 of older investors still do not possess any. Bitmine Immersion Technologies has been transformed into what is known as a pure-play, non-leveraged Ethereum treasury in the meantime. The plan is to increase the target stake to 5% of the whole Ethereum network through equity financing. According to him, the real value of Ethereum, its command over the stablecoin system, and Wall Street's formal entry into blockchain through initiatives like the SEX Project Crypto and the anticipated FIT21 Act are more important than speculation, given its inherent 3% staking return, which he believes has the potential to produce constant dividends and long-term revenue flows for investors. He even projects that Ethereum may eventually surpass Bitcoin in terms of market size. This is more than a quick deal or a short-term wager in his opinion. According to him, it is investing in the foundation of the financial system of the future rather than betting on hype. He views the AI revolution as a protracted supercycle that spreads gains much beyond the few megatech names that are boosting entire industries, going beyond crypto. His conclusion is straightforward. This is not a repeat of 2021. The value of the entire market is still reasonable. Corporate America has demonstrated its resilience, and a great deal of demand is still awaiting discharge due to excessive caution in business. Crypto is still extremely early in its evolution, with institutional acceptance and legal clarity set to propel the next stage. The data points to one conclusion for Lee. We're not done yet. We have yet to arrive. We appreciate your time, and please remember to like and subscribe.